Welcome to the Deep Dive, presented by Finbot Insights. Today, we're plunging into the intricate currents that truly move the financial world. We're going far beyond just the conventional financial metrics.
Right.
Our exploration is really about unearthing the profound, often unconscious influences that, well, sculpt investment decisions. The central question we're tackling is, what truly drives investor choices, especially when those choices seem to go beyond pure rationality?
Exactly. And our mission here in this deep dive is really to extract some vital insights from a collection of recent academic research and expert commentary. We're drawing specifically from some pretty groundbreaking studies on behavioral biases. We'll also examine the subtle yet measurable impact of time-induced stress on financial markets. And we'll also dissect the historical resilience of markets, especially when faced with significant geopolitical events. The objective really is to furnish you with a comprehensive and nuanced understanding of why investors so frequently deviate from purely rational behavior, and also how external factors can subtly shape perceptions of risk, and critically, what practical implications all this holds for managing your own investment portfolio.
That sounds like an ambitious and frankly incredibly important undertaking. It offers a deep, multifaceted perspective that, while many traditional analyses tend to overlook. So we're delighted to guide you through this complex, yet I think highly relevant terrain. Let's begin then by examining the very fabric of investment decision-making. It's a foundational concept, really, and one that's increasingly validated by modern research, that these choices aren't exclusively driven by, logical analysis of figures and data.
Mhm.
In fact, psychological biases and deeply ingrained emotions exert a significant and often profoundly irrational influence that can dramatically impact financial outcomes.
Absolutely. And this perspective fundamentally challenges those long-held assumptions of historical rational economic models. The ones that typically presumed investors act solely on available information and pure dispassionate logic. There's pioneering work by Rishi Kumar and Dr. Hitesh Kisarwani contributing to this growing body of behavioral finance research. It definitively demonstrates that psychological and cognitive biases frequently lead to what appears, well, from a purely economic standpoint, as irrational financial decisions. Their study really highlights this deviation from strict rationality as a kind of pervasive phenomenon. It underscores the paramount importance of understanding investor psychology because it directly impacts both broader market dynamics and, of course, individual portfolio performance.
Right. And this fundamental deviation from pure logic, it's something every one of us really needs to consider within our own investment practices, isn't it?
Hmm.
Acknowledging the profound role played by emotions or past experiences, or even the subtle pressures of what our peers are doing, it's crucial for recognizing potential pitfalls within your personal investment strategies. It's really about understanding the deeper why behind decisions that might otherwise seem inexplicable, when viewed solely through a rational lens. This self-awareness can be a powerful antidote.
Definitely. And to address these deviations precisely, the study we're looking at meticulously details specific identifiable biases that consistently lead to, well, suboptimal investment selections and also contribute to market inefficiencies. One really prominent and pervasive bias is overconfidence.
Ah, yes, thinking you know more than you do.
Exactly. It's defined as investors overestimating their own knowledge and abilities. They often believe they possess superior insight or control over market outcomes than is, objectively warranted. This frequently results in underestimating the inherent risks and this tendency to engage in excessive trading.
Which can really hurt returns over time.
It absolutely can precipitate significant losses. That false sense of certainty can blind investors to critical warning signs or prompt them to take on far more risk than they realize. Then there's loss aversion. This is a really deeply ingrained psychological phenomenon. It describes the disproportionate fear of losses relative to the pleasure derived from equivalent gains.
So losing $100 feels much worse than gaining $100 feels good.
Precisely. The pain is often felt far more acutely. And this bias can compel investors to, say, prematurely sell winning stocks. They want to lock in profits too early and then miss out on further upside. Or, conversely, and perhaps more damagingly, to hold on to losing equities for far too long, just clinging to the hope of a rebound.
Right, the it'll come back mentality.
Yeah. And this latter behavior is frequently exacerbated by regret aversion. That's an emotional bias where individuals try to avoid taking actions that might later evoke regret. So this often translates into inaction or suboptimal choices, like failing to cut losses when a position is clearly deteriorating simply to avoid the regret of admitting they made a bad decision.
Procrastination driven by fear.
In a way, yes. Another powerful force shaping market behavior is herd mentality,
Following the crowd.
characterized as the inclination to mimic the actions of a larger group, rather than formulating independent judgments based on fundamental analysis. It's not necessarily deliberate collusion, but more a collective susceptibility to follow the crowd. Maybe it's driven by FOMO, fear of missing out, or perhaps the belief that the majority must be right.
And this can really amplify market moves, can it?
Significantly, this collective behavior can exacerbate market movements, contributing to the rapid formation of asset bubbles where valuations become completely detached from reality. Or, conversely, it can contribute to sharp market crashes when collective panic takes hold. When many investors act on the same impulse, it creates this self-reinforcing cycle that can push prices far from their intrinsic value.
Scary stuff when you think about it collectively.
It is. Then we have confirmation bias. This is a pervasive human tendency to selectively seek out and interpret information that validates beliefs we already hold, and at the same time, consciously or unconsciously disregarding contradictory evidence.
So we look for news that tells us we were right to buy that stock.
Exactly. In an investment context, this can be particularly insidious. It might lead to prolonged holding of underperforming assets as investors only seek out news that supports their initial decision. Or, conversely, it might lead to overlooking profitable new opportunities simply because they don't align with prior assumptions about market trends or specific companies. It creates a kind of echo chamber in your own mind.
Makes sense. What else?
Anchoring. This represents an over-reliance on an initial piece of information, an anchor, when making subsequent decisions. So investors might fixate on a historical stock price, or maybe their initial purchase price, as this unshakable reference point.
Even if the company's situation has totally changed.
Right. Even in the face of new and highly relevant market data that suggests a different valuation or course of action, this anchoring can prevent objective reassessment and lead to missed opportunities or holding on to positions long past their logical expiry. The example you hear is if a stock was once $100, an investor might feel $50 is automatically a bargain, even if the underlying company fundamentals have drastically deteriorated.
I can see how that happens.
Yeah. Additionally, there's hindsight bias. This describes that post-event belief that one could have accurately foreseen market movements.
The I knew it all along effect.
Precisely. After a major market event, people often say, "Oh, I knew that was going to happen." The irony is, this can lead to increased overconfidence in future investment decisions. It makes individuals even more susceptible to other biases because they believe their past predictions were more accurate than they actually were. It distorts memory and perception, creating a dangerous illusion of foresight.
Right, makes you feel smarter than you were.
Exactly. And finally, let's touch on familiarity bias. This is the preference for investing solely in well-known or, say, local stocks, companies you hear about all the time.
Seems harmless enough on the surface.
It seems innocuous, but this preference can be highly detrimental. It often leads to insufficient diversification and consequently elevated portfolio risk. By concentrating your exposure to specific geographic regions or industries simply because they are familiar, you forego the benefits of spreading risk across a broader array of assets. It leaves your portfolio unnecessarily vulnerable.
So, understanding this whole taxonomy of irrationality, it isn't just an academic exercise, is it? It's really instrumental for improving your financial judgment.
Absolutely.
Recognizing these specific biases within your own decision-making framework seems paramount. That self-awareness provides the critical foundation for, well, effective self-correction and ultimately achieving better future investment outcomes. It's about knowing your own mind as much as knowing the market and actively working to counteract these deeply ingrained predispositions.
Well put. And these behavioral biases aren't just theoretical constructs. They are powerful forces that have profoundly shaped major financial events throughout history. They've left a clear imprint on market behavior. Consider the dot-com bubble back in 1999 to 2000.
A classic example.
Right. This era stands as a primary example of widespread herd mentality and overconfidence bias just run rampant. Investors disproportionately flock to technology stocks, driven by this, well, irrational belief in perpetual growth. They often overlook fundamental valuation metrics or even the basic profitability or lack thereof of these nascent companies.
Valuations went crazy.
Totally detached from reality. This speculative frenzy led to extreme market overvaluation. You had companies with minimal revenue and no clear path to profit being valued in the billions. And when the underlying reality eventually asserted itself, there was a sharp, calamitous decline. Widespread bankruptcies, a drastic shift in investor mood, and trillions of dollars in wealth just evaporated.
A stark illustration of irrational excitement overriding fundamentals.
Indeed. And a more recent example, the 2008 financial crisis.
Still fresh in many minds.
Very much so. This crisis serves as a stark instance of the combined impacts of overconfidence and subsequently profound loss aversion. Both individual and institutional investors systematically undervalued the substantial risks associated with mortgage-backed securities. They were buoyed by this pervasive, almost unquestioned assumption that property values would just keep appreciating forever.
That collective overconfidence fueled excessive borrowing and complex risk-taking throughout the financial system.
It did. And when the housing bubble inevitably burst and subprime mortgages began to default en masse, fear-driven selling just took over. The market collapsed, threatening the entire global financial system. This catastrophe really exemplified how behavioral biases contribute not only to speculative boons by ignoring risks, but also to destructive busts. Investors who had previously disregarded warning signs were suddenly overcome by panic, driving asset prices even lower.
These historical events really serve as crucial, maybe stark, reminders that even highly developed markets and their most experienced participants are profoundly vulnerable to widespread psychological pitfalls. Applying these lessons seems vital to avoid similar traps in your own investment journey. It reinforces the need for disciplined, evidence-based decision-making rather than just succumbing to emotional impulses, which can be amplified by that collective behavior.
Fortunately, the study also outlines actionable strategies, things designed to mitigate the impact of these pervasive biases and foster more rational decision-making. A cornerstone strategy is diversification.
Spreading your bets.
Essentially, yes. Spreading investments across various asset classes, industries, and geographical regions fundamentally reduces the impact any single poor decision or concentrated bias. This directly combats tendencies like familiarity bias, which, as we said, can lead to overconcentration in well-known local stocks, exposing a portfolio to unnecessary idiosyncratic risks.
So true diversification provides a structural safeguard.
Exactly. Against individual missteps or unforeseen events affecting just one area. Another critical strategy is disciplined investing.
Sticking to the plan.
That's the core of it. It advocates for strict adherence to a predefined investment plan and the conscious avoidance of impulsive decisions driven by short-term market fluctuations or emotional reactions. Such discipline directly counters biases like loss aversion, which might prompt panic selling during a downturn, and herd mentality, which encourages following the crowd without independent analysis, regardless of fundamental value. A disciplined approach means setting rules and sticking to them, even when your emotions are screaming at you to do otherwise.
Easier said than done sometimes, but crucial.
Absolutely. And finally, the continuous pursuit of financial education is paramount, stressing the ongoing acquisition of knowledge regarding broader market dynamics, core investment principles, and, critically, behavioral finance itself. This equips investors with the essential self-awareness required to identify and effectively address their inherent biases. This continuous learning process transforms abstract concepts into practical tools for improved judgment. It allows investors to understand not just what to do, but why certain behaviors are detrimental and how to mitigate them. Framing these strategies as proactive measures really empowers the retail investor, doesn't it, to cultivate a more logical, long-term approach to their finances. By systematically applying these principles, you can potentially achieve superior financial outcomes and more robust asset accumulation. It's about moving beyond reactive decision-making towards a more intentional and strategic investment path. Well said. It's about taking control by understanding the controllers within and around you.
Okay, so while understanding our internal biases is crucial, it's equally important to consider the external forces that influence markets, often in surprising ways. Which brings us to a, well, somewhat provocative idea. Despite the profound human impact of global conflicts and geopolitical events, historical market data indicates a remarkable resilience of broadly diversified investment portfolios to such turmoil. It suggests a kind of disconnect between human suffering and market performance that can be, frankly, difficult to reconcile.
It can be. And this perspective is captured quite eloquently in Anthony Isola's recent commentary, pointedly titled, "Empathy Isn't Part of the S&P 500. Isola asserts that, quote, "War and mayhem are market constituents and forever will be." He views the stock market as a, quote, "microcosm of the actions of billions of often irrational human beings that, while reacting to events, ultimately processes these shocks without being fundamentally destroyed by them."
That's a strong statement. Does the data back it up?
Well, to illustrate this point with some compelling historical data, consider that since Israel declared statehood on May 14, 1948, the S&P 500 has multiplied an astonishing 350-fold. It grew from approximately 18 to over 6,000 by June 2025. That represents an impressive annual return of 10%, including reinvested dividends.
Wow, 350-fold through all that time.
Exactly. And it's crucial to emphasize that this substantial growth transpired amidst continuous regional chaos, including the conflicts ISIL notes and numerous other major global conflicts. Yet, through all this upheaval, the market continued its long-term upward trajectory. It reflects the long-term compounding of corporate earnings and, well, human ingenuity. Furthermore, ISIL's analysis suggests that significant market drawdowns are more closely correlated with economic recessions than with geopolitical events themselves.
So it's the economy, not necessarily the conflict itself, that drives big downturns.
That's what the analysis suggests. He highlights that major market downturns, like those in 1956, 1973, or during 2001, were often attributable to underlying exogenous factors, things like economic contractions, high inflation, or credit crises, rather than direct conflict impacts. This suggests that while geopolitical events might trigger short-term volatility or emotional reactions, the long-term health and direction of the market are more fundamentally tethered to core economic conditions and corporate profitability. These tend to recover over time, regardless of isolated political disruptions. The market, in essence, prices in long-term corporate earnings and the global nature of capital, which can adapt even to regional instability.
That historical perspective offers a powerful challenge to the instinct to panic sell during crises, doesn't it?
It really does.
It reinforces the notion that waiting for global peace before investing isn't really a fiscally sound strategy for diversified portfolios. The market's consistent long-term upward trend, even through periods of intense human suffering and geopolitical upheaval, suggests a fundamental detachment from those immediate emotional responses. It implies that while individual events cause immense pain, the aggregate productive capacity of humanity tends to, well, rebuild and advance.
And to further address the impact of these external shocks, ISIL reiterates the critical role of broad diversification across asset classes, investment styles, countries. This is highlighted as the proven methodology for mitigating the impact of such unpredictable external events. He issues a clear warning stating, quote, "All bets are off if you own a concentrated leveraged portfolio, ignoring the proven benefits of broad diversification."
So the market might be resilient overall, but your portfolio needs to be built for resilience too.
Precisely. It underscores that while the market as a whole may be resilient due to its vast and adaptable nature, individual portfolios require careful construction to withstand volatility and provide consistent returns. Diversification is the investor's primary shield against the unknown.
It reinforces that valuable advice one of Isola's longtime clients shared. When things are bad, don't look at your portfolio. Instead, take two actions: leave things alone or buy more.
That's great advice.
It really encapsulates the philosophy of staying power, faith, and a strong stomach, qualities that the legendary investor Barton Biggs attributed as essential for successful long-term investing. And it's also worth noting, isn't it, that markets frequently rally during periods of peak conflict, often anticipating future improvement or reflecting that underlying economic resilience even amidst global challenges.
That counterintuitive behavior is often observed, yes. It reinforces the idea that reacting emotionally to headlines can be detrimental to long-term financial health. In essence, diversification serves as a robust defense against unpredictable external events, while simultaneously fostering a disciplined mindset during periods of market distress. It's about building a portfolio that's structurally prepared for the unexpected, allowing you to maintain your long-term strategy rather than reacting impulsively to transient headlines or global crises. This long-term perspective and structural resilience are key takeaways.
Okay, now let's introduce a new and I think incredibly fascinating dimension of external influence. This is the subtle yet significant impact of daily stressors, even something as commonplace as time constraints on financial decision-making in real markets.
Oh, yeah? Yeah.
This is where the intricacies of human physiology subtly meet the world of high finance, demonstrating that even professional traders aren't immune to everyday pressures.
Exactly. This phenomenon is explored in depth by Gelman and Kliger's time-induced stress effects study. This research specifically examines the influence of acute stress, which is intensified by factors like time constraints and external interference, for instance, the daily aggravation of arriving unexpectedly late to work.
Like getting stuck in traffic.
Precisely. The study looks at how this affects professional investors, and what makes this study particularly groundbreaking is its departure from prior lab experiments. It analyzes real-world market behavior, offering empirical insights into how stress manifests in actual trading decisions among experienced professionals in a live trading environment.
So not just students in a lab setting.
Right. The foundational hypothesis for this research comes from accumulated lab findings, which consistently suggest that time stress primarily impacts financial decisions within the loss domain, meaning when individuals are under acute stress, it specifically alters how they perceive and respond to potential losing scenarios. They often become disproportionately sensitive to negative outcomes.
Okay, so how did they test this in the real world?
Well, Gelman and Kleiger employed a really unique data set. It included Moscow traffic congestion data from Yandex, covering 2011 to 2013, measured by something called a deceleration coefficient.
A deceleration coefficient.
Yeah, it basically served as a precise, scientifically validated proxy for the acute daily stress these traders experienced just before the market opened. How much slower was traffic than usual? They also incorporated local weather conditions and, crucially, derivative prices for RTS futures options. The research specifically focused on unexpected traffic congestion shocks as the stressor just prior to the market open at 10 a.m. on the Moscow exchange, looking for immediate market responses.
And what were they measuring in the market?
The primary dependent variable used to measure the effect of this stress was the slope of the implied volatility function, or IVF, of options on RTS futures, and they specifically concentrated on the left-hand side of the volatility smile.
Okay, unpack that a bit. The volatility smile and the left-hand side.
Right. So the IVF, you can think of it as the market's collective fear gauge for a particular asset. Implied volatility shows the market's expectation of future price swings. The smile refers to the typical shape you see when you plot implied volatility against options strike prices. Options further away from the current price often have higher implied volatility. The left-hand side corresponds specifically to the loss domain. These are the out-of-the-money put options that protect against price drops.
Got it. So a steeper slope there means more fear of losses.
Exactly. A steeper slope on that left-hand side indicates that investors are assigning higher weights or probabilities to extreme loss scenarios. They're pricing in a greater likelihood of significant negative movements. The methodology for calculating this involved, some complex stuff, inverting the modified Black-Scholes formula for futures-like options and categorizing options based on their delta-based moneyness. But the key takeaway is it provided a robust and precise measurement of subtle shifts in risk perception, particularly for those options designed to hedge against downside movements.
So, these intricate findings suggest that the aggregated emotional states of traders, stemming from something as common as a frustrating morning commute, can subtly yet measurably manifest in significant shifts within these highly technical market indicators related to risk perception.
That's the implication.
It's a remarkable demonstration of how personal, seemingly mundane experiences can ripple through collective financial behavior, even influencing the pricing of complex derivatives.
It really is. And the study's core finding is compelling. They identified a statistically significant correlation between those morning traffic jams and an increased perception of extreme loss scenarios among these professional investors.
How significant was the effect?
Well, to quantify the tangible impact, the slope of the IVF at the opening of the main trading session 10 a.m. Moscow exchange was demonstrably higher subsequent to morning traffic jams. Specifically, one standard deviation higher in unexpected congestion. That purified stress variable correlated with an 84 basis point steeper slope.
84 basis points? How big is that in context?
Well, it's less than 1 percentage point. But in the world of options trading, where tiny shifts dictate huge sums, this represents about 1/9 of a standard deviation higher slope for the IVF. It's a statistically significant spike in fear, a quantifiable increase in how much traders braced for and priced in extreme negative outcomes. And this effect was particularly pronounced and statistically robust in put options, which are, as we said, more directly linked to perceived downside risk. These were calculated using the more liquid, frequently traded out-of-the-money options, indicating a clear flight to downside protection.
Wow, so the stress really showed up in the pricing.
It did. But a crucial discovery was the transitory nature of this effect.
Meaning it didn't last.
Right. It completely disappeared by the market close. This strongly indicates that stress-induced biases predominantly influence immediate trading decisions made right after the exposure to stress, rather than lingering throughout the day. And this finding was further confirmed by a robustness check involving evening traffic data, which yielded no significant influence on the morning's trading patterns. This solidified the conclusion that it was the pre-market open acute stress that was the operative factor.
That's fascinating. So this research provides empirical evidence of how acute real-world stressors, things seemingly disconnected from fundamental market analysis, can directly translate into altered risk assessments in financial markets. It shows a measurable tendency, particularly to exaggerate the perceived likelihood of negative outcomes.
Yes, specifically in that loss domain.
It really illustrates the subtle yet profound ways human physiology and psychology can impact the pricing of even highly technical financial instruments. It reminds us that the human element is embedded deeply within market mechanics, affecting even the most rational calculations.
Absolutely. So synthesizing our discussions, it becomes clear that investment decisions are shaped not only by those inherent psychological biases influencing individual judgment, but they're also profoundly vulnerable to transient external stressors that can subtly shift collective perceptions. This creates this complex web of influences that can lead to significant deviations from optimal rational behavior, highlighting the multifaceted nature of market dynamics and investor choices.
Indeed. We've seen how internal cognitive and emotional biases like overconfidence leading to excessive trading, loss aversion causing premature selling or clinging to losing assets, and herd mentality fueling bubbles or crashes consistently lead investors astray, as evidenced by major historical market events. Simultaneously, external factors like geopolitical unrest, while not historically obliterating diversified portfolios, undeniably trigger emotional responses. They reveal a deep human tendency to react impulsively to alarming headlines. And now we understand that even acute, everyday stressors, like a frustrating traffic jam, can subtly but measurably alter risk perception. It leads professional traders to assign an overweighting to extreme loss scenarios in derivative pricing, impacting real-world valuations.
And this integrated perspective strongly aligns with the risk as feelings hypothesis.
Explain that a bit.
Well, it posits that emotional states directly influence risk perception and decision-making. This framework elegantly links individual biases, which are often driven by emotional responses, with external stressors that induce specific emotional states, like anxiety or frustration. This integrated view highlights that both internal biases and external pressures culminate in observable impacts on investor choices and broader market phenomena. It creates a more complete picture than any single factor could provide. It underscores that understanding the human emotional landscape is just as critical as understanding financial models.
This sophisticated, integrated view provides you, the listener, with a deeper understanding of the multifaceted forces influencing your investments. It underscores that truly rational investing involves understanding yourself and the environment just as much as it involves understanding financial models and statistical analyses. It's a holistic approach, really.
It is. And given this comprehensive understanding, we can now offer some concrete strategies for the astute retail investor. Ways to cultivate a disciplined approach that transcends emotional impulses and external market noise. The crucial first step is self-awareness as a tool.
Knowing thyself.
Exactly. Acknowledge that all investors, regardless of experience or expertise, are susceptible to these biases. The goal isn't immunity that's likely impossible given our inherent human nature, but rather the goal is to develop the ability to recognize when a decision might be swayed by overconfidence, loss aversion, or herd behavior. This self-recognition is the fundamental prerequisite for any form of self-correction.
And better decision-making down the line.
Right. Next, strategic diversification remains the most robust defense against both internal biases, like familiarity bias leading to concentrated holdings, and external shocks, including geopolitical events. It serves as a logical counterpoint to emotional reactions, providing that structural safeguard for your portfolio. By spreading investments across various asset classes, industries, geographical regions, you fundamentally reduce the impact of any single poor decision or unforeseen event.
Fortifying the portfolio.
Precisely. Then, the long-term horizon is paramount.
Patience is key.
Absolutely. The historical performance of the S&P 500, despite enduring decades of global turmoil and conflict, strongly supports maintaining a long-term investment perspective. This perspective helps contextualize short-term market fluctuations, whether induced by stress, news, or major geopolitical events, recognizing they typically don't dictate long-term portfolio success. That powerful advice to leave things alone or buy more during crises directly applies this principle. It emphasizes patience and a strategic outlook beyond immediate headlines.
Looking past the noise.
Exactly. We also advocate for focusing on process over outcome.
How you decide, not just what happens immediately after.
Right. Focus on making sound decisions based on a well-defined investment plan and fundamental analysis, rather than reacting impulsively to short-term gains or losses. This approach helps mitigate regret aversion and the allure of excessive trading. It fosters a more consistent and disciplined investment journey. By prioritizing a robust and thoughtful process, you inherently mitigate the influence of transient emotional states and external noise, leading to more consistent and effective long-term results, even if individual short-term outcomes are unpredictable.
That makes a lot of sense. Shifting focus from results to method.
And a newer but equally important consideration is mindfulness of stress. We advise listeners to be acutely aware that their personal stress levels, even from daily occurrences like that traffic jam, might subtly influence their financial judgments. As we've seen, under stress, investors may consciously or unconsciously assign higher probabilities to extreme negative events. Recognizing this physiological link is a powerful form of self-management.
So maybe don't make big investment decisions right after a really stressful meeting.
That would be prudent advice, yes. It suggests taking a pause before making significant financial decisions if you find yourself in a heightened state of stress. Furthermore, our sources compel us to consider another crucial dimension beyond pure financial returns: ethical alignment in investing.
This is moving beyond just the numbers.
It is. While not a traditional financial metric, intentional ignorance regarding what one's money supports, or prioritizing portfolio performance exclusively over ethical scandals, while that can be a clear indication that financial returns are, perhaps unconsciously, dictating personal morals, it raises a question for investors about what constitutes wealth beyond pure monetary accumulation.
And what about ESG specifically, environmental, social, governance investing?
Right. When it comes to ESG considerations, the perception that these funds are too political is itself a viewpoint worth examining. Choosing not to invest ethically is, in fact, a decision that carries its own implications. Defending a company's ethical track record based solely on its financial performance, or refraining from divesting from uncomfortable holdings despite personal discomfort, that indicates a prioritization of profit over principle.
It reveals where one's values truly lie.
It does, and it compels a deeper reflection on what defines personal success and impact. Finally, we must challenge the notion that it's just business absolves one from broader accountability.
That old chestnut.
Exactly. It's long served as a shield against ethical scrutiny. But financial decisions have real-world impacts on people and ecosystems. Prioritizing return on investment, or ROI, exclusively over potentially lower yielding but value-aligned options inherently represents a trade-off integrity for percentage points. We encourage intentional investing. This means consciously aligning your investments with your personal values. This approach, while perhaps not maximizing immediate financial returns, can yield a different kind of wealth integrity. It can foster peace of mind, contribute to societal impact, and build a positive legacy beyond mere financial accumulation.
So it's about ensuring your portfolio reflects your principles as much as it reflects your financial goals.
Precisely.
This comprehensive approach really empowers the investor then to transcend purely reactive decision-making. It enables you to construct a resilient portfolio that aligns not only with your financial objectives, but also with your deepest personal values. It fosters a more holistic and maybe meaningful relationship with your wealth.
I think that's a good way to put it. Building a financial life that truly reflects who you are. And to actively navigate these emotional and external influences, we can propose several practical strategies. Things designed to help investors override those primal responses and make more objective decisions. First, automated investing can be incredibly powerful.
Set it and forget it.
To some extent, yes. Implementing automated contributions and portfolio rebalancing significantly reduces the emotional friction associated with manual decisions, especially during volatile market periods when impulses might otherwise lead to suboptimal choices. Automation helps you stick to your plan even when emotions are running high.
Takes the temptation away.
It does. Second, consider maintaining decision journals.
Writing down why you did what you did.
Exactly. Documenting your investment decisions, the rationale behind them, and importantly, your emotional state at the time. This can be profoundly insightful. This practice allows you to identify recurring biases and patterns in your own behavior. It offers a tangible path to self-improvement and a clearer understanding of your financial psychology.
Like reviewing game tape for an athlete.
That's a great analogy. Third, seeking disconfirming evidence. This is a direct countermeasure to confirmation bias. Actively search for information that challenges your existing beliefs rather than only confirming them. This forces a more balanced perspective and can reveal critical blind spots in your analysis, leading to more robust decision-making.
Harder to do, but important.
Very much so. Fourth, consider professional guidance. Working with a financial advisor who possesses a deep understanding of behavioral finance can provide an invaluable objective perspective. Such an advisor can serve as a critical counterbalance to emotional impulses, helping you adhere to your long-term plan even when markets are turbulent or your personal biases might otherwise take hold.
A behavioral coach for your finances.
In a sense, yes. And finally, cultivate mindful awareness. Encourage a conscious awareness of your physical and emotional state before making significant financial decisions. This simple practice can provide a crucial pause, especially when operating under stress. It allows for more deliberate and rational thought before committing to a course of action.
Just taking a breath.
Essentially, it's about recognizing when your emotional state might be influencing your judgment and taking steps to counteract it.
These proactive measures offer concrete, practical tools for applying the theoretical knowledge we've discussed today. By integrating these strategies, you can translate these profound insights into tangible improvements in your investment discipline, ultimately leading to more consistent and successful financial outcomes. Our deep dive today has really illuminated the complex interplay between investor psychology, external stressors, and broader market outcomes. We've explored how inherent behavioral biases often sway decisions away from pure rationality, how the subtle impacts of daily stress can measurably alter risk perception, and how the market, in its long-term trajectory, demonstrates that remarkable indifference to even profound geopolitical turmoil. A truly well-informed investor understands not only the financial figures, but also these profound, often hidden influences shaping their choices.
Absolutely. And as you reflect on these insights, perhaps consider this. If even a simple morning traffic jam can subtly alter how professional traders perceive risk and value options in the last domain, how might your own unrecognized daily stressors, or perhaps even unconscious biases, be silently shaping your financial future? What unseen factors might be influencing your next investment decision, and how might acknowledging them transform your approach to wealth and well-being?
That's a powerful thought to leave our listeners with. We certainly trust this deep dive has provided you with valuable insights for your investment journey. If you found this discussion insightful, we strongly encourage you to click the like button and subscribe to the FinBot Insights channel. We offer more in-depth explorations of the forces shaping our financial world. Your engagement really is instrumental in enabling us to continue providing these comprehensive analyses. Thanks for joining us.